خير جميعا يعطيكم ألف عافية. Welcome to this interesting master class, The Art of Valuation with Yaman AlJundi. We're getting our program and our master classes with subject matter experts per discipline. It's gonna be a series of master classes which we will stream to the ecosystem in Jordan. I'll do just a brief intro. Our facilitator today, Yaman AlJundi. Well, Yaman is a veteran corporate executive with a focus on financial and business analysis. He holds a master's in finance from DePaul University and achieved the CMA accreditation. He's held senior roles in finance, strategy, and investor relations in the telecom industries for companies including Zain, Etisalat, and Vodafone. And most recently, he founded his ad tech startup that empowers companies to launch targeted digital out-of-home campaigns while allowing local businesses to monetize their footfall. So, Yaman, welcome on board. The floor is yours. Looking forward to this session.
Thank you, Rizak, and thank you everyone for being here. It's my pleasure to present the art of valuation today. I'm a fellow corepreneur with you in this cohort. And I'd ask you to think about why this course is titled The Art of Valuation rather than, for example, the science of valuation. I think you'll find that as we move along, it's more of an art to come up with a valuation than a science, even though we're using scientific formulas, and you'll see why shortly. I'll present share my presentation. You can see the presentation, Rizak? Okay.
Yes, sir.
So before we start, to kind of get things started, I think some people might be just waking up even because it's Ramadan. I wanted to start with a question. If you had a choice today between getting $1 million in cash or getting $30,000 in annual payments forever in perpetuity, which one would you choose? You can write it in the chat, or let's say, like, if you would choose option one, raise your hand or write it in the chat. I'm interested. Depends. Okay. So far it's split between 1 million and the 30,000. Some people are saying, and depending on the strategy, both are okay. Okay, good. I'm glad that there's a difference between the responses. 1 million. So the truth is that there's no wrong answer, right? If you, let's say your bank pays you 3% on a savings deposit, and that's a very safe investment where you can put your money. If you look at the value of both of these and you take it, the value of them today, the 1 million in cash today would obviously be worth 1 million. But you can do a calculation for the perpetuity of the interest payment that you're receiving forever, which is basically the payment divided by the interest rate. So in this case, 30,000 divided by the 3% also equals 1 million. So in the world of finance, both of these options, given that this is the discount rate that you're using, both of these options are the same. So really it depends on your personal choice. Do you want to receive that in installments? Do you want to receive it today? Maybe you have alternative ways you can invest in and make more money. But I want you to think about this kind of the effect of compound interest and the time value of money as we're talking about the valuation. Also, some things to keep in mind as we move along. I want to talk about a few myths around valuation that are very important. So number one, valuations are objective. This is a false statement. anybody that's preparing a valuation is making estimates and projections and assumptions about the future. So they have an inherent bias depending on where they're coming from. You might be a founder and you're trying to overvalue your startup to the investor so that you receive higher cash and you give up less equity, or the other way around. You could be an investor and you're trying to lowball the founder of the company by coming up with a valuation that's lower than what the company's worth. So it's impossible to have 100% objective valuation. In the same vein, you can't say that a valuation is precise. This is false, because in a valuation figure doesn't exist in nature. There's no true valuation. What sets the price of a company or any asset is the market, and it's based on supply and demand. So it's always going to be a negotiation. It's always going to depend on a lot of factors. So there's no correct answer for evaluation at any given point in time. One last thing I want to dispel is some people think that the more complicated the valuation model is, the more accurate it is. But in fact, it's the opposite, because the more inputs that you can see a fancy model and you see a lot of inputs, a lot of science and research behind it. But the bigger the model, the more assumptions that you're making, and the more opportunities you're introducing for errors. So the best models, even in terms of the time that you spend on models, it's good to not spend too much time to where it's overkill. So usually the simplest models and the easiest ones to understand actually perform the best. So today we're going to talk about two main approaches to valuation. One is intrinsic and the other is relative. When we say intrinsic, we're talking about looking at the asset itself or the company itself and its ability to generate the cash flows and the risks associated with that specific company in that specific sector, in that specific geography. So this is a deep dive into a specific company and an analysis of that company. The other way to value is through relative valuation. You might have heard of price multiples. And this is when you take a group of comparable companies or comparable assets and you scale them to a common metric. So for example, you might look at a group of companies that operate in the same space and you look at the size of their sales or the number of their customers, and you compare that against their price in the market. And we'll go into that in detail. So let's also quickly talk about why do we need valuation? The theory behind needing valuation is that markets are inefficient and they can make mistakes when assessing value. So prices are always changing for assets, and it takes time for the market to recognize that these prices have changed. In the context of the stock market, it could be that a company is overvalued, or a certain sector is currently overvalued based on the stock price. And eventually, when the returns come in and the financial results come in, then a correction happens. In the context that we're talking about today as a startup, you might have raised around, let's say, $1 million for your valuation. And then 6 months on, you've doubled your revenue and your company's worth more. So you're still technically valued at 1 million, but your company's now, let's say, worth 2 million. This is the kind of inefficiency that needs to be corrected. And because there's no market price that's providing a fair value of this asset or this company, that's why you need a valuation to justify this model. This methodology also, or this philosophy, also assumes that every inefficiency is going to be corrected over time. So when you invest in a company today, because you believe it's undervalued, you believe that at some point in time, somebody's going to come and acquire the company at a higher valuation, and that's how you're going to make your return. So the markets are inefficient, and these inefficiencies are going to be corrected over time. And we use the valuations to justify our own estimated valuation, and we exploit the variance between our own valuation figure and the one currently in the market. That's how we make our profits. So the first intrinsic approach is the discounted cash flow valuation. This one you're probably all familiar with if you've worked on your financial projections and used them to come up with a valuation. And essentially, it's the present value of all the future expected cash flows from your company. Like I said, this looks at the intrinsic value of the company. So you're looking at the company itself and its own ability to generate cash flows independent of other companies in the market. And to come up with a discounted cash flow valuation, you need three things. You need an estimate of future cash flows. You need to know the life of the asset. For our context, when we're talking about our startups, we assume that they're a going concern, so they're going to continue forever. And you need a discount rate, which is basically the expected rate of return. We'll go into that in more detail shortly. Now, very quickly, the advantages of a DCF valuation. Because they're based on fundamental analysis is the analysis of the company's financials and their strategy and their management team, and really looking at the company and its qualities. Because you're looking at the company and doing that kind of analysis, it should be more objective than using a comparison with what the market is currently pricing companies. It also forces you to deep dive into the company's business, so you'll really truly understand it. You might have discussions with the founders and the management. You'll really dig in and understand the business model. This is obviously an advantage if you're an investor. Even if you're a founder and you're valuing your own company, it might force you to look into aspects that you haven't looked at before. And it's less affected by market perception. So let's say, like there's one of the sectors is the big thing today, all the hype is around it, but it's overvalued. Doing a DCF valuation, looks past the market hype and the market noise, and it really allows you to do, a deep focused analysis of the company. Now, I wanted to ask you guys what you think the disadvantages of DCF valuation are. So what would be a disadvantage of creating a financial model and coming up with a valuation, especially given the context of us as startups?
I think they don't update themselves. You have to update them.
Okay. They do, yeah, they do require a lot of upkeep. In the comments, discount rate might be misleading. That's good as well. So, like you said, it requires more detailed information. It requires a lot of updates, and that involves time, right? So, compared to other methods of valuation, you really need to, dig into the company and make a lot of assumptions, because you're basically projecting financials for, 5 years, 7 years. You can't just multiply by, some factor of growth and project out. You really need to look at, how the company is going to perform year by year. You need to look at the discount rate. You need to look at a lot of things that takes a lot of time and also introduces a lot of room for error. Abir says that it's not accurate for pre-revenue startups, need to include other models. Yes, you don't have any historical financials or very little information. So the assumptions that you're making are not based on anything from the past. So there's a lot of room for error, and it's quite difficult for pre-revenue startups. It's hard to predict how the company is going to perform if the product isn't out in the market yet. Another disadvantage is that it's easy to manipulate. So if you're a good analyst, or you're good at hiding numbers, you might have a preconceived valuation figure in mind, and you want to reach that figure. Let's say you're pitching it to an investor, and you're presenting this model and saying this is the justification for why I set my valuation figure at 3 million, for example. If you know what you're doing, you can adjust certain numbers. You can decrease the investment. You can increase the returns. You can increase the number of customers that you're getting. You can adjust the discount rate to reach any number that you want, really. So unless you take an objective approach to a DCF valuation, you can basically use it to arrive at any number that you want. Now, one is the best time to use a DCF valuation. Like we said, it's good when you have a long-term investment horizon. So you're talking about like 5 to 7 years, and you're looking at each year, and you're projecting how much you're going to make in those years. And you're looking at the long-term value of the company. So it makes sense for you to look at the financials year by year and look at the cash flows coming in. It's also great for investors that are able to add value to the company. So if you're an accelerator or you're an active investor and you can bring certain knowledge or certain networks or certain strategic partnerships that's going to move the company to reach the milestones and targets, it's good to match it with a DCF valuation. And because it's a long-term investment, it's good for investors that don't care about what the market says currently. So if you're looking to flip this investment within the next 6 months, you would obviously care what the market thinks more. You would look at where investors are investing now. But if you're looking at a horizon of 5 years, you're not really looking at what the market is saying today. Now, I want to get into an example of a DCF valuation. But first, we need to go over a few basic concepts. The time value of money, the net present value, the free cash flow, the discount rate, and the terminal value. We're going to go through them one by one, and then put them together into a DCF model. So time value of money, we touched on that briefly when I asked you about the $1 million question. And the basic concept, we're all familiar with, is that money today is worth more than money that you receive at a future date because of its earning potential. So if you can have that money, that cash in hand today, you can invest it and earn on it, so that its future value would be more than it is today, and vice versa. So if you take an example, let's say you had an investment that paid 7% annually, and it reached $5,000 in 1 year. So in 1 year, at 7%, you would get a total return of $5,000. If you wanted to take the present value of this investment, you would divide that $5,000 by 1 over the discount rate, which is 7%, to the power of 1, because we're talking about a time horizon of 1 year. And that would equal $4,673. So in other words, the $5,000 that you're going to receive from that investment in 1 year, today is worth $4,673 to you. So if you had this amount, the 4,600, you can invest it at 7%, and you could have 5,000. So this is very important when you're looking at the cash flows, the future cash flows of your company. And the net present value is basically just the sum of the present value of all the future cash flows. So you look at all your cash inflows and all your cash outflows, and you discount them back to their present value, and you take their sum. And this is the net present value of this investment or this project or any kind of investment that you're making. If the NPV is positive, so taking into account that you're getting X returns, these are the inflows, and you're making X investments, these are the outflows. If after discounting cash flows, the NPV is positive, then this is an attractive investment. That means you're going to make money for this investment. But it's not just a matter of having a positive NPV. You're going to need to look at this absolute figure and compare it with other similar investments to decide where to put your money. So if you have two investment choices and there's one NPV that's higher than the other, you would also obviously go for the investment with the higher NPV. And when we're valuing companies, what we're doing is essentially getting the net present value of all future cash flows to today's value. Now, another thing we need to understand is the free cash flow. Does anybody know why it's called a free cash flow? You can write it in the chat if you'd like.
When some country copy the money a lot, so the money don't have the value, the same value that it does have.
Yeah, so it's free because this is the money that you have left over, like you're saying, to use for basically your financiers or your investors. So after I subtract or after I take, I calculate my cash returns, my cash income received, and then I subtract from it the reinvestment that I need to make in the company, in buying assets or investing in software, etc. I'm going to have an amount left over that I don't need to use for the company operation. And this amount is free for me to use to either repay my creditors. If I have a loan, for example, I can pay off a loan, or I can decide to pay a dividend to my investors, to my shareholders. So this is what we call free cash flow, and this is the best proxy to use when you're valuing a company. So you'll typically see companies using maybe different things like net income or EBITDA, maybe subtracting investment from it. But the most accurate figure to use is the free cash flow, because this is the actual figure that you can use to pay the investors. And as you know, investors get paid through dividends, essentially, or by being bought out through an acquisition or by selling their stock. So the formula for a free cash flow, you need to take out the tax that you'll pay. So you do a calculation around that. And then you add back the depreciation, which is a non-cash expense. This is the investment that you made, for example, in your software at the beginning of your launch. And then you're doing an amortization over X number of years, maybe 2-3 years. So this is a non-cash amount. It doesn't affect the cash that's coming in, but it shows up on your income statement. So you add the depreciation expense back to your earnings because it's a non-cash item. Like we said, you subtract your capital expenditure. This is your reinvestment in the company, any investment that you make towards your fixed assets or your software. And then you also take into account the change in working capital. Working capital is your current assets minus your current liabilities. That basically reflects your ability to pay off your short-term interests. And all of these items are available if you're preparing financial statements. All of them are available on your statement of cash flows. If you remember, the statement of cash flows kind of balances between where it takes into account the income statement and the balance sheet, and it turns your net income into actual cash generated. So you'll find all of these items in your statement of cash flows. So when you do a projection, if you're also doing a projection in terms of the cash flows, which you should be doing, you can look at the change in your working capital year on year. I think for most cases, for early stage companies, if you're doing a lot of cash transactions, this isn't going to be a big amount. But if you're dealing with, let's say, like governments or something, and they're paying, over a period of a year or 2 years, then this might be an issue, obviously, with the timing of your receiving payments. The next thing we need to cover is the discount rate or the cost of capital or the rate of return. This is basically the required return necessary to make this investment worthwhile. So usually it's calculated as adding a certain premium associated with the investment to a risk-free rate. The risk-free rate is basically the rate that you would get from a safe loan, for example. Let's say like you make a deposit in a bank and you get 2%, 3%, 4%, whatever it is. This is considered a risk-free rate. But obviously, because you're investing, like in our context, in a startup, you need to add a premium to this kind of investment. You know, there are a lot of risks involved with investing in a company, let alone in investing in a startup. So what financial analysts do is they come up with sophisticated models to come up with a cost of capital to determine, you know, for each company, what an accurate rate of return or an accurate rate of return would be that would qualify making an investment in this company. We're not going to get into the you know, the specific formulas. I just want you to understand like how it's made. If you're a company that has equity and debt, so if you have loans, analysts will also take that into account. So they look at the distribution of your equity versus your debt, and they'll assign a certain rate of return for each, and they'll arrive at what they call a weighted average cost of capital. I wanted to note, so just for reference, like if you're talking about companies, mature companies like telecom companies in the stock market, typically you might be looking at a discount rate of 12% to 15%, depending on the market. But when you're talking about startups, especially early stage startups, that number can double and triple, just so you have a reference. In most cases, if you want to apply a discount rate, I would ask a venture capitalist or an investor, or you know, look up like a certain range, and maybe even make like a simulation where you're applying different discount rates and kind of getting a range for what your valuation comes out to be. But it should be, I would say, north of 20%, 25%. Now, the terminal value, this is a value that's assigned to the future cash flows that are beyond the period that you forecasted. So let's say you forecasted for 5 years, you know, your financial projections, but you're a going concern, right? You're going to be, your company is going to continue beyond that point, but it's, you know, it gets a bit difficult and tedious to start, you know, projecting into year, you know, 11 and year 12, right? So you need an easy way to assign a value to all the future cash flows that are beyond the horizon of the projection that you're making. So what they do is that they assume that the cash flows past this horizon are going to grow at a stable growth rate forever. And there's a calculation for it, where you multiply you take the FCF, the free cash flow of the last year of the horizon, you add the growth rate to it, and then you divide it by the difference between the discount rate and the terminal growth rate. And I also wanted to note that in the tech sector, the first, you know, this is taking an average, looking at previous companies. The first 8 years for most companies yield negative cash flows. So they're paying more in terms of outflows than they're making in terms of inflows, their returns. So when you look at the assigned value for a company, 125% of it is coming from the terminal value. So let's say you did a projection for 5 years, you might have negative cash flows for those 5 years, but then you're breaking even in year 5. And then in the next, you know, X number of years, this is where you're projecting all your value is coming from. So the terminal value is very important, is a very important driver for your valuation, and it's also very sensitive. So if you make any adjustment to your discount rate or to your growth rate, that's going to have a tremendous impact on your valuation, especially because most of your valuation is coming from that terminal value. You'll see all of this put together in the model very shortly. So let me move my picture so that we can see the numbers. So all of us should have a 5-year, at least a 5-year projection. I have the, some numbers here that are just for the sake of the example. We have the EBITDA, we add back the depreciation, we subtract the capital expenditure, the change in working capital, and now we have a free cash flow to the firm, a projection over the next 5 years. So now we apply a discount rate. In this case, I applied a discount rate of 10% to reach the same free cash flows, but discounted. So if you look at the discount factor, in year 1, it's 0.91. In year 2, it's 0.83. In year 3 is 0.75, and so on. The further away the cash flow is, the higher the discount factor is going to be. So then you take these discounted, or you come up with the terminal value. So you'll take the free cash flow from year 5, and you'll apply the formula that we just discussed, and you'll come up with a terminal value for that year 5, and you'll discount that back to your present to the present day. So you'll take a present value of your future cash flows for the 5-year horizon. That's the row in blue, and you'll take your terminal value. And you'll take the present value of that and add those together to reach your NPV, or in this case, your enterprise value, which is the total value of the firm. I'm going to share an Excel template of this model. Obviously, you might need to make adjustments based on your own financials, your own business model. But this is the basic way, using this formula to reach a valuation figure using the DCF. Obviously, it's going to come down to what kind of assumptions you make for your terminal growth rate and your discount rate, and these are things that we can discuss individually. So I also wanted to share this slide from Swivel's recent investor deck. If you read the links that were sent out for the course, you'd know that Swivel just recently did an IPO. So they had a prospectus, basically like an investor deck, that went out for the investors, that talked about the company, its results, its future growth prospects. And they don't have a specific DCF valuation in the deck, but they do have their projected financials over the next 5 years. And there's a couple of things that I noted that I wanted to point out just to show you how much impact your projections can have on your valuation. So if you notice, they have a software as a service revenue line, which just started basically in 2021. This is basically their business line. And you look at it, basically went from nothing in 2020 to a projection of 600 million in 2025. So the gross revenue, they're assuming over the next 5 years, is going to grow by more than 100% every year. It's going to more than double every year. And if you look at their adjusted EBITDA, you'll notice also that they have negative EBITDA for the first 3 years in their projection, and then they start breaking even in year 4, and then predicting positive EBITDA in year 5. So the valuation is taking most of its value from this final year of positive EBITDA. So obviously it's a very ambitious projection, but I think what they're using to support it is that they were able to double their revenue over their first 4 years of existence. 2020 was obviously like because of COVID, maybe it was a bit stagnant. But they believe that, you know, with the investments that they're making and with the acquisitions that they're making, that they're going to double their revenue, and that they're going to be able to achieve economies of scale and hit a positive EBITDA within year 5. And this is where most of the value is coming from for this valuation. So now we'll move on to relative valuation. Relative valuation is also called pricing. And this is when you take similar companies. Usually you use public companies that are in your same sector, or you might use recent M&A, recent acquisitions of startups that are also similar to your company. So if you have a competitor that was recently acquired and you know the valuation of that that they were acquired at, and you also know, for example, how much sales they have or how many customers they have, you can use that as a benchmark to compare against your own company. So for relative valuation, obviously we're valuing the company based on the perceived value from the market. We're not doing it based on you know, a fundamental analysis of the company. We're looking at how the market perceives similar companies and applying those same metrics to our own company. Now, to do that, we need a group of similar companies. This is probably the most challenging for you know, some startups, especially ones that are innovating in new spaces and can't find a lot of companies that are operating in the same space. You also need a standardized measure to scale your common metric. Yaman asks, how do we get this information? So you need to look at, if you want to collect a universe of companies that are similar, you basically need to look at the sector that you're in, and then go on you know, all the major stock markets and find companies that are in that same sector and look at the multiples that they're trading at. This is one thing that you need to do. The more early stage the company, so like the late stage companies, these are mature markets, they're not going to have much growth. It's still good to track them and see what multiple they're trading at. But the companies that you can find that just recently started or that are investing in technology, these are the kind of companies where you really should be tracking their performance. And the good thing with public companies, obviously, is that they have to make disclosures as far as their customers and their sales and their earnings. So you can easily come up with the multiples and try to apply them to your own company. And you can also do searches for M&A transactions in this space. So, try to look up any kind of company that's operating a competitor or in a different market that's offering a similar product that was recently acquired. You can go on TechCrunch or any of these websites that track the M&A activity and the investments, and look at how these companies were valued, how much money they raised, what series they're at. All of that information can give you sort of a starting point so that you can compare against your own startup. It's pretty challenging. Like, it's something that I faced personally with my own startup, because I couldn't find as many companies, our companies in media and advertising. I couldn't find that many companies that were in that space that had that kind of information. Obviously, you don't just take it, so if this company is in this sector, a similar sector in a similar geography, I can use that multiple, or I can make that direct comparison. I can make adjustments if needed, depending on where those companies are in terms of their finance, in terms of their funding rounds, their maturity, in terms of their business model. You can make all sorts of adjustments to reach a valuation that you think is fair. So the advantages of relative valuation, obviously, that they reflect market perceptions. So if you're looking to, what the market is saying matters to you, and you're looking at a horizon of, let's say, like 6 months, you want to sell, make a return on your investment, then obviously you care about what the market thinks, and relative valuation gives you that kind of insight. Another advantage is that it requires less information. You don't have to do this deep dive into the company and its financials and its historicals and the management team, etc. If you can find a group of companies that are similar, you can simply apply that factor to the company and reach a valuation pretty quickly. And it's great for when you're making an investment decision. So essentially, what you're doing is you're ranking the companies based on a certain common metric, and then you can make a decision between those companies, which one is the most attractive to invest in. It should be the one that's the most undervalued, obviously. So I'm going to ask again, what do you think are the disadvantages of relative valuation? Basically using pricing multiples. What do you think would be a disadvantage of using a relative valuation? Okay, people are saying hard to use for innovative new startups and subjective measures. I think with valuation, almost everything is going to be subjective. It's just how persuasive you can be and how much data you can use to back up your assumption. And it's difficult to have, exactly, right. It's not easy to find comparable assets, 100%. This is something that I've gone through myself. You're always going to have to find somewhat similar companies, unless you're launching in a space where you're not innovating and you're copying a model, and they've gone public or they've had a lot of M&A, and you can do a pretty direct comparison. One way to try to circumvent the errors that might occur is to try to find as many companies, similar companies as possible, and use them as a group, kind of find an average, and that way you can have get a more a safer result for your valuation. Another disadvantage is that it establishes a ranking of assets, but it doesn't give you a real intrinsic value. So because the market itself, let's say the market itself is overvalued, like a certain sector, everybody's buying, and there's a lot of hype around it, and you use the trading multiples at that specific point in time. Now the market is going to make a correction in the future. All of the whole sector is going to come down, but you can't tell that based on relative valuation, because you're looking at the trading multiples at that specific point in time. So you're basically just ranking these companies against each other, but you're not really looking at their true value. This is another slide from Swivel's deck that looks at the relative valuation. So what they did was that they compared themselves to peers in shared economy and peers that have similar software as a service. So you'll see in there, you'd be surprised that they're comparing themselves to Airbnb, right? It's not just transportation, any kind of shared economy public company, they felt that it was applicable to compare it, to their business. And they're also using food delivery and basic delivery companies, even though Swivel is a mass transit business model. So basically what they're saying here, if you look at their enterprise value, they're comparing their enterprise value, which is the total value of the firm, against revenue. So Swivel's enterprise value for their 2022 revenue projection is 8 times. And if you compare that to the shared economy peers, it's a similar valuation. So that basically they're saying we should be trading at this price for our IPO, because if you take this group of companies that operate in the same space, this is their average. And we're still growing. So it's fair to say that we should be trading at 8 times our 2022 revenue estimation. I think it's smart of them also to compare themselves to the software as a service. You know, these companies probably have a business model that has a higher margin as far as the you know, their income margin. So those peers are trading at 20 times the 2022 sales projection. So what Swivel is essentially saying is that we're undervalued because we're, you know, currently we're at 8 times at this IPO price, but similar companies that have a software as a service are trading at 20 times. So you can increase your investment today at, you know, approximately 2.5 times when the market corrects our price and we start trading at a similar multiple to our peers in the software as a service, the SaaS. So I just thought it was interesting. I wanted to share it with you. These are the kinds of things that companies share with investors to kind of build their investment case and justify the IPO price. Now, I wanted to talk the second part of this presentation is going to speak about the challenges in the context of a startup. So we've been talking mostly about valuation just in general. It can apply to any asset class. It can apply to you know, mature companies, public companies. But now we want to talk about the specific issues that arise for startups when they're doing evaluation. One common problem is finding a relative valuation metric. So the metric can be it could be sales, it could be earnings. In most cases, for startups, their earnings are negative, so it's not something that you can compare to others. It could be sales, but even if you're pre-revenue, you know, what metric can you use to compare yourself with other companies and arrive at a valuation? You might be looking at the number of transactions or the number of customers, even if they're not paying customers yet. You know, you need to find some kind of common metric that you can use to compare. And obviously, you know, your number of customers is something that you protect. You know, you don't share that with the market. So it's pretty hard to get that information from other, you know, early stage startups that are basically competitors to you. We discussed finding similar startups. Another issue is the high failure rates. So when you're comparing, you know, when you're comparing yourself to other companies, these are companies that have gotten past that threshold and they're, you know, generating revenue, they're well funded. So their risk profile is different from a company like yours that still has, inshallah, you know, we all succeed, but the reality is that 90% of startups fail. So if we're all still in the early stage and we haven't, you know, come out of that bottleneck yet, there's a high risk involved with the, you know, chance of failure, which needs to be factored into the valuation. Equity claims and illiquidity. This relates to the different classes of shares. So you might have preferred shares, you might have shares with certain rights that might complicate, you know, when you're doing evaluation and you're doing setting a price for your equity. If you have different classes of shares and different investors that have different rights, this can make things complicated and it could pose a risk to future investors or to early investors. And illiquidity is the idea that your startup is not always on sale, right? So if somebody makes an investment in your company, it's going to take maybe 5-6 years until you're able to exit, until you're able to make that acquisition. So basically your company, your stock is illiquid. So the people that have invested in you, they won't see a return until they see another company come in and buy their shares, right? So that also is a risk that's involved with early stage startups. This is a nice chart that I found that basically summarizes the financing life cycle. Obviously, when we're doing valuations, they're usually around, we're raising funds. We're doing, a series of fundraising, depending on where we are in terms of our revenue and in terms of our growth. So in the first stage, the seed stage, we're raising money from probably angels, friends and family. We might be pre-revenue until we see that that month-on-month, exponential growth, and that's when we get into the later rounds of financing, Series A, Series B. This is usually considered early stage. Investors might be VCs, private equity. It could be strategic investments from more established companies that are in the same space that want to get some exposure to your technology. And then you start moving into the later stages, and you might eventually move towards an IPO or an all-out acquisition from a larger player. So if you look at looking at the same kind of life cycle, but in terms of valuation, like we've been saying, the past few minutes, when you're in early stage and you're pre-revenue, the assessment of your company might be a bit more qualitative. So when you're in the seed early stage, companies might be more looking at your founding team, your technology, your product, the size of your market. They're looking at more qualitative aspects of your company because there aren't as many quantitative aspects. You don't have a few years of historical financials that they can look through. And then as you move towards later rounds, it starts to become a bit more quantitative. So you have a bit more information, and then they can start using that information to do relative valuation. They can look at competitors, and they can look at people in the same space. If there's any recent M&A activity, at what valuation were they valued, compared to their size. You have enough financials to start building, a proper DCF model that, can be justified and backed. I'll share this, you'll have this presentation, so you look at the kind of questions that investors might ask and use to assess your company. And we're going to look at a few of these qualitative aspects for companies that are early stage and pre-revenue. So this is, let me just move myself again so I'm not in the way. This is a method called the Burkus method. And basically it creates a few factors, a few categories for assessment of your company, and it assigns a certain maximum value for each of these. In this case, it's 500,000, but depending on the geography, it might be lower in Jordan, for example, depending on the sector. You'll set some certain amount that you'll assign as a maximum value to each of these categories. And then you'll assess the company based on that. So they look at your idea, they look at your prototype, they look at the quality of your management, they look at your strategic relationships, and they look at your product rollout or sales. So in this example, they're assigning different values to these different factors, and then they arrive at a valuation. It's a simple way to do a valuation, but if you're talking about a pre-revenue startup and you already kind of have an idea that you like this team and you're willing to invest, then this is an easy way to just to develop a starting valuation without having to get into trying to forecast projections when the company might not have even entered the market yet. This is a similar model, but it adds a weight factor. and a comparison to peers. So the first thing you do, it's called the scorecard method. First thing you do is that you take similar companies from the market that are similar to the company that you're analyzing. And then you find an average valuation for those companies at a similar stage. So let's say you identify 5 companies, and at that specific stage, they were valued at $2.5 million. Now you take a group of factors and you assign a certain weight to each of these factors, depending on what's important to you as an investor. In this case, they're looking at the management team, the size of the opportunity, the product, the competitive environment, the marketing and sales, the need for additional investment, and other factors. You'll note that in most cases, especially like in the early stage, most of the weight is going to be assigned to the management team and to the size of the opportunity. So if the size of the opportunity, if the market that you're in is large enough to grow your sales, and they believe in you as a founder and as a management team, then they're pretty confident that you're going to be able to figure out the rest of the things, the product, the technology, the marketing. All of that is going to come later. But you can have the best marketing and the best roadmap and rollout, etc. But if there's no size, if there's no not significant market size for the product that you're rolling out, you'll never be able to get the returns that the investors are looking for. So once you assign a weight to each of these factors, you basically do a comparison to your peers, to the similar companies. If you're at the same level, you'll get 100%. If you're better than them, you'll get higher than 100%. Or if you're worse, you'll get lower than 100%. And then you multiply those two together, and then you'll get a factor that you can multiply with the average company valuation that you had gotten for those companies. And then you would have a valuation, which is basically a relative valuation for your own company. Now, these kinds of methods are used by the these venture capital firms and investors, but I think it's a great exercise for all of us to apply them to our own startups. So we can use these models and try to think objectively as an investor. I want to these are the kind of things that they're looking at. These are the kind of weights that are assigned. Let me see what kind of companies they would compare me to, and let me see what kind of score I would get. And then you can have you can reach not only a valuation figure, but it might also help you in preparing your pitch deck. So you might identify your strengths, and you'll put more emphasis on them as you're pitching, because you know that these things are important to the investor. And then if you identify any weaknesses, that's also something that you can work on. So doing these kinds of exercises is important, even if you're not an investor. This is a similar model to the scorecard, but it's looking at more factors, and it's doing the score based on a scale from -2 to +2, from very negative to very positive, 0 being neutral. It's just another way that companies might assign a value to your company if you're an early stage and don't have your pre-revenue, or you just started. So the venture capital method, this is something I found that is actually quite simple to come up with, but you do need a DCF. So if you remember, we were saying before that most of the value for tech startups is in the terminal value. It's not in the first 5 years, because they're making negative free cash flows probably for that horizon. So for most VCs, they have a certain horizon of time before they want to exit. Let's say it's 5 years, and they also know that to invest in a very early stage startup, this is the minimum amount of return that I would expect. Here it's called the hurdle rate. In this case, it's very high. It's 50%. So if I know, if I have a terminal value for this company, I know that I want to make a 50% return, and I know that I want to exit in 5 years. I can do a simple post-money valuation formula by taking the terminal value and dividing it by 1 plus the discount rate to the power of the number of years, which is 5 years in this case, and then I'll arrive at what this company is valued at today. This is a pretty simple way for a venture capital firm to assign a value, but it would require some effort, obviously, for arriving at the terminal value. Now, there are also some non-financial signals that investors will look at. We touched on these briefly in the methodologies that we just discussed. So number one, the management team. Obviously, and these are things that you can use to improve your own valuation, even if you don't have the financials and the results in the market yet. So the management team, the more experienced they are, the more exits they have, the more well-known they are. That obviously is going to assign a certain value to your valuation. So you need to have a diverse management team as well. People with different specialties that work well together, that have known each other for a long time. These are all factors that'll increase your valuation. If you have previous financial backers, a lot of the first thing most companies will do is look at who's invested in you in the past. So if you have some big names, some prestigious names that have invested in you, that means that they've done the due diligence, and that kind of gives an assurance to future investors about the promise of returns for your company. And if you can also have advisors or board members that are also well-known or prestigious, that will also add that value to your decision-making and your strategy. Another thing that's non-financial but also might add value is a strategic partnership. So let's say you're not, you don't have your product rolled out yet, but you have a strategic partnership with a certain government or a certain big corporate, and you have some kind of exclusive deal or some kind of agreement to sell them your product or to work together. These are all, give assurance to your future cash flows and will certainly boost your valuation. Now, another thing that I wanted to touch on briefly is pre-money and post-money. This, question comes up when you're having a discussion with the VC. Usually they'll ask you how much money are you willing to raise, are you wanting to raise, and at what valuation, and then they might ask you, well, is that pre-money or is that post-money? And basically that's talking about the timing of the valuation in relation to the payment. So when you're saying, I'm valued at 1 million pre-money, that means the company is currently worth 1 million, and then you're going to be adding, the capital injection. But if you're saying it's 1 million post-money, you're saying that the capital injection is going to occur, and then you're going to be worth $1 million. I found two examples here from Investopedia. In both cases, the valuation is set at 1 million, and the investor is paying $250,000. But in one case, it's pre-money, and in the other case, it's post-money. So in the pre-money, the entrepreneur owns a company that's already worth $1 million. The investor adds $250,000. So the total value of the equity now is 1.25 million. And in terms of percentage, the entrepreneur owns 80% and the investor owns 20%. Now in the post-money, where the valuation is going to be 1 million after the capital injection, basically the entrepreneur's stake was valued at 750,000. The investor added 250,000 to reach 1 million. And in this case, the entrepreneur is left with 75% of the stake rather than 80%. Now, in theory, it doesn't matter. You can price it pre-money, and you can price it post-money. But it's important to, this is based on your negotiation with the investor, but it's important to know the difference, because this is something that's going to be in writing when they do the investment. So just keep that in mind when you're giving out that number. I think, at least for me, when I think of a valuation figure, I usually think of it post-money. So I have in mind that they're going to pay, X amount, and they're going to get X percent. So when I say the valuation figure, I'm usually referring to the post-money. But just keep that in mind if they ask you that. So we've gone a bit quicker than I anticipated, but I wanted to leave you with we're going to have a Q&A session at the end. But I had a couple of last minute thoughts when I was preparing it. Or actually, I found a couple of things that I found interesting. So Warren Buffett, you should all know who Warren Buffett is. If you don't, he's a famous investor, one of the most successful investors in U.S. history, and he takes long positions. He does, he looks at the companies he invests in holistically. You might say that he's a bit risk averse. He doesn't like getting into, a lot of speculation. But he famously said that if he were teaching a finance course, he would ask students to evaluate an internet stock, or you could say like a tech stock, and any student giving an answer would flunk. So what he's basically saying is that he would give them, these tech companies to basically financially analyze and provide a valuation. And any student that attempted to assign a value to these companies would receive an F, just because he's basically saying there's so much, there's so many assumptions, there's so much uncertainty. These sectors are such always like evolving pretty rapidly. With all these unknowns, it's almost impossible to really assign a value to these kinds of companies. So anybody that's attempting to analyze them based on traditional models would receive an F, at least according to Warren Buffett. Another thing that interesting stat that I found in 2015, 72% of the IPOs for companies that IPO'd that year, a year later were trading below the IPO price. So if you remember when we were talking about the swivel example, obviously they're going to come in at an IPO price that's built on a valuation, because they were a private company before. And for more than 70% of the companies that IPO'd in 2015, a year later they were trading at a lower price. That means that the market corrected that inefficiency and lowered the price of those companies, even though they were set at such high expectations, at such high valuations. Just something that I wanted you to keep in mind. If we go back to Swivel, this is a snapshot of their stock price as of last night. So they had a initial stock price of $10 at a valuation. I think their EV was around 1.1 billion. They're a unicorn, and their IPO price was set at $10. They did it through something called a SPAC, which is it's a special purpose investment that's already listed, and then they merge with it. It's a sophisticated way to to launch it on NASDAQ, but it's something that's becoming more prevalent. But it was basically trading at $10, and then when the merger occurred and Swivel officially started trading on NASDAQ, if you can see, it started on March 31st, and it immediately went down as low as $4. So it lost 60% of the value that was assigned, in their valuation when they did the IPO. So within 1 month, it went down 60%, but now it's back up to $6. So based on everything that we've said, and based on what you know about their sector and their peers, I was just interested to know if any of you think that this is if this is a good opportunity. If you were to value this company, looking at peers, looking at their past results, do you think this is an opportunity for growth, or do you think that their price is going to sort of settle around you know, this $6, $7 range? Anybody invested in shared economy or looked at their business model? Do you think that they're going to be able to hit those kinds of targets? Okay, I mean, I guess we'll see. Yeah, go ahead.
شكرا أول شيء يامن. هلا أنا بصراحة مش قادر أحكم 100%، بس بناء على الشيء اللي عم بشوفه بجوز لو كان التايم فريم أكبر رح أقدر أحكم بشكل أفضل، فممكن أتأنى قبل ما أعمل انفستمنت. هلا هي صحيح صار في هبوط لكن الأمور عم ترجع تتحسن، فممكن أعمل ريسك لكن مش رح تكون كبيرة. لو كان التايم فريم أكبر أكيد رح يكون القرار أكثر دقة.
مظبوط. هلا الواحد بده يطلع، تنسيش كمان بده يطلع مش بس على الماركت. هلا الماركت بجوز يعني برضه الواحد لما يعمل يعني when you're doing a comparison stock performance, you need to look at the general market. So maybe there was some things that brought the market down. You need to look at similar companies as well. يعني you can never look at a stock alone. But in terms fundamentally, if you're looking at the company, you know, you should have a view of يعني how they're going to perform. فهلا this company, I'll add their investor deck to the list of resources that are available for this course. It's very complicated, but I would recommend that you all look through it, because you can see how sophisticated their model is, how sophisticated their strategy has become. I'm sure that it wasn't like that when they first started. But they have a very ambitious, you know, roadmap. They're going to make acquisitions, you know, in different continents. They've already made some, and they're banking on the fact that their technology and their management is going to be able to manage all of this, you know, very quick expansion and achieve economies of scale, you know, and hit their earning target in 5 years. So. If you believe in the company, if you believe in the management and you believe in their product, and you look at what they've done in the past, this might present an interesting investment case. And when you look at this kind of company, you know, think of yourself, even though, you know, we're not at the IPO stage yet, inshallah, yani, these are the kind of things that companies are looking at. And they're looking at companies, you know, it's a huge universe of companies. There's a lot of investment alternatives. And there's limited cash, so each fund has a limited amount of money that they can deploy, and they're going to be looking at your company versus, you know, other opportunities that they have to invest. So you need to find where your strengths are and really push them so that you can justify the valuation that that you're going for. And I guess we're going to get into that yani, individually, inshallah, with the one-on-one sessions.
Thank you.
We'll open it now for Q&A. We have about half an hour. If anybody had any specific questions related to any of the things that we went over, or any specific issues that you faced, happy to answer them.
Thank you, Yaman, for an amazing session. Amazing refresher, amazing insights. يعطيك العافية. I'd love to hear from you guys. Any questions, any elaboration that you want to gain regarding specific component? Feel free. By the way, Yaman, we have a couple of interesting comments on LinkedIn since we streamed the session.
Sorry, we have a couple of what? Can you raise your voice?
We have a couple of interesting comments on LinkedIn.
LinkedIn. Oh, can you read them?
Yeah. Basically, it's a bit late because once we're targeting specific elements while you were presenting. That's some interesting stuff. Apart from the fans that are greeting you, someone mentioned regarding the stock, Swivel's stock. You can't isolate that information without taking into account other factors. You should also take into account that most companies trade at least 20 to 30% premium on the day succeeding their IPO. That's a broker, by the way.
Yeah.
That's an equity broker. So, yeah, Javier has something interesting. What do you suggest for intangible assets valuation, IP, unique biometric data, research outcomes, and the like?
Yeah, so I think we can, Abir, we can do that one-on-one, and so I can really get and look into your company. But again, I would look at companies with similar models, or that sell similar, are in the same space, and look at the kinds of financials and the kind of valuations that they're trading at. So even if you have, an IP that might not be, translated into revenues immediately, there's some value assigned, and all of that is going to come from the terminal value, and that might come from maybe a couple of big agreements that you do, like strategic partnerships that you do with companies that can use the biometric data, for example. You might not be selling it to, obviously, to customers. You're going to be doing it as a sort of service, software contract with a big company. So we can look together into companies with similar models, and the kinds of customers that they have, the size of the agreements that they have, their sales, and do a present value of those future cash flows to today's value. Anyone else? Anyone else have any specific issue that they faced with when they were negotiating with did they get any feedback on their the valuation figure that they presented in a pitch deck?
Jahan, I want you to clarify a couple of points. At early stages, as you mentioned earlier, probably the investment preference will look at qualitative stuff such as team, so on and so forth. What do you think, or how do you think proper storytelling can convey better valuation and better message for investors, especially at early stages where we are right now, right? Because I guess all of our companies see the pre-seed. So how important is storytelling to investors in order to be convincing enough and probably have a better valuation?
Yeah, so I would say that especially at our stage, I was thinking about it, and even preparing for this course, kind of I started thinking about my own startups and my own experience. Because these analysts have so many companies to analyze, some of them are. I'm not pointing anyone out, but in a lot of cases, people are tend to be lazy, so they like to find ready information, right? So if you've done the homework for them and you present it, you do a DCF, regardless of what the numbers, the projections, you're taking a lot of assumptions, but you've done that exercise. You've done an exercise and given them the size of the market. You've gotten into your management team, what each one of them brings, how you work together, etc. You're kind of putting down like all of those like main things and going into detail and presenting it as if they've already made. They're already going to invest in you, but they just need to come up with the value. You've done a lot of the work for them, so they might give you a bit more thought. If you just tell them, this is my company, this is what we're doing, this is what I'm trying to raise at this valuation, you're still leaving them with having to do that homework. They're usually going to try to find a similar company, a peer. They might ask around about the market that you're in, is it competitive, etc. And then they're going to make a decision, a quick decision based on that. So it might not be the right decision, right? I mean, a lot of successful companies, a lot of founders, they like to recount the stories of them being rejected by so many companies before somebody took a chance, and then they succeeded. So having that information like spelled out for them, very detailed. Obviously, they don't have a lot of time to go through, but having like the highlights of it, and maybe having like a backup model and a backup information about your market that's available, kind of gives them that if they're a little bit interested, then they would dig in a little bit more, and you've saved them a lot of time. Another thing I would say is that the two most important things are the size of the market and the team in the early stage. So the team, you can have a presentation and put slides and put I worked here, I worked there, but the real way that you build that kind of confidence, especially like in a market like Jordan, is by putting yourself out there. So the more active you are, the more they've seen you around, in different events and different accelerators, maybe commenting, writing on LinkedIn. Your name has some equity and your team, and this is something that for them that breaks the ice and kind of gives them confidence in you as a person. If you have a personal friendship with them, all the better, because obviously they know you and they know your passion. But if you don't have that, at least like build those professional relationships. I think that goes a long way in getting that, getting over that hump in the beginning.
Thank you, Yaman. A segue to another question, to clarify, how important is it to target the right VC/investor vis-a-vis their investment preference? We know that some VCs tend to like e-commerce platforms, and most of our companies are tech. Just take a high level 2021, بس in MENA region, 17 deep tech companies got investment. On the contrary, 100 companies got investment, e-commerce companies. So how important is it to reach out to the right investors?
Yeah, this is like when we were talking about the hype and the market sentiment. Unfortunately, even some of these investors, they can get caught up in the hype, even though it's they're talking about a horizon of 5-6 years. So if they're seeing other companies, that are getting valued at these astronomical valuations, they're going to want to get in on that on the action, and they might be looking at the top line and not really like seeing if these business models are going to be sustainable in the long term. So I would suggest for all of us to really think about what kinds of companies to have the investors in mind while we're perfecting our business model. So if we know that these are the kinds of companies that are getting invested in, and these are the kind of sectors that are getting invested in, we should be trying to pivot somewhat so that we can pitch something that's familiar to these investors. Unless you have like some private equity or a strategic partner that's in this same industry and sector that would be very interested in your technology or in your new business model, it's difficult to stand out, especially here in the region. So in the region, we have a limited number of VCs, and they have, they're looking at specific areas that they find interest in. I think probably the easiest way would be to, and they're easy to reach for on LinkedIn especially, and like in the ecosystem, you probably know somebody that knows them. So it'd be good to reach out to them directly and ask them what kind of things are you interested in, what kind of sectors. Who do you know that's interested in these kinds of, in the space that I'm in specifically? And if you have a big market opportunity and you have like a strong product and you feel like you can, really like present like a strong case, you can even reach out internationally. And there's companies that help you identify investors that might be willing to invest in your company. The only thing I would say is that in the context of Jordan, it's a pretty small market. So if you're going to do that, if you're going to try to find international investors, pitch them a market that they would see, sizable enough to warrant their investment. So we're talking about like at least regionally, like Saudi Arabia and Egypt, or internationally.
Guys, any other questions?
Yaman had a question in the chat. Investors look for optimistic figures. What would you do if you believe you can't achieve high projections in the near future? So I come from a finance background, so I have this problem of being, maybe Jumana, you are too, I'm not sure, but I tend to be very conservative when I do projections. I tend to be very realistic, and I think a lot about the constraints more than the potential. So I think this is a problem with us having worked in accounting or finance. I think that you can be as optimistic as you want, because you're essentially saying you're going to give me the funding I need, to get to where I want to get. All of these companies that you see now getting funded and they're very successful. They're getting, in some cases now, hundreds of millions of dollars in their Series C or Series D. That's a lot of money, and that's a lot of money that they're using to fuel their growth. So never let the funding be the constraint. If the constraint is, I don't have enough resources, I need to make changes to the product. But what you're essentially asking for is the money to be able to do that, right? So if you know that the market is big enough, you know that you can get those revenues. When you do the that exercise, the total addressable market and the what was it? The total addressable market and total attainable market. If that's big enough to meet the milestones that the investors are looking for, then put those milestones. But at the same time, tell them that I'm going to have to increase my my operating spend and my investment by X, and based on that, I'm going to need an investment of whatever it is. So inflate your sales if the market can sustain those kinds of numbers, but also increase your expenses accordingly.
I think ما بعرف إذا حدا عنده أي سؤال. بس couple of things before we finalize. Nadine بعتت over the chat the assessment for this training session, so I will appreciate if you fill it. Won't take more than a minute منكم. الشغلة الثانية, Yaman is available for one-on-one coaching sessions. So تقدروا تحجزوا عن طريق نادين زي Thank you so much, guys. Yaman, يعطيك العافية. شكرا.
الله يعطيك. Thank you, everyone. I'm happy to look at the and you're not only looking at the valuation, but also looking at the financial projections. So if you're not confident about the financial side of it, do these numbers make sense? Are these expenses in the right place? Am I accounting for the capex? كل هالأمور, I'm also happy to assist you with that so that we can get, and we should all at the end of the cohort have at least a 5-year projection that we can confidently defend, inshallah, justify for the valuation.
I agree. جمانة رافعة ايدها. جمانة, please go.
مرحبا. Thank you, Yaman, so much for this session. It was really good and some kind intense. في شيء بس بدي أسأل عنه. في وقت أنا شوي كنت مش connected. كان في بالvaluation في non-financial metrics or some kind of non-financial valuation. So are you going to share material اللي أخذناها هلا عشان في أشياء لك أعرف okay.
100%. It'll all be available, and I 100% recommend that you do that kind of assessment for your own company. Not only to get like a valuation, but also to assess your strengths, and it'll help you in the conversation with the investors.
Indeed. Thank you so much, Yaman, and everyone. Thank you.
Thank you guys. والعافية ونشوفكم قريبا إن شاء الله.